Hello, Big Trends Traders. This is Price Headley with your Options Swing Trader product review. We're going to share with you an interesting strategy in a particular indicator that I've typically used for a trend following approach, but actually has also shown to have, at some extremes, some very good reversal qualities. So we'll walk you through that and how we take advantage of that on a little bit of a longer swing trade horizon. I'd say more like between a week and 2 weeks typically, rather than the usual 3 to 5 days. Before I get into it, just a reminder that everything that I'm sharing with you here today is for your information and education only. Nothing that we talk about here should be considered a specific recommendation to buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. Big Trends and its staff are not responsible for any trades you choose to make, and not all Big Trends products or services are appropriate for all types of traders and investors. Big Trends doesn't provide personalized financial, tax, or legal advice to any individual. What we do is we take our swing trader research and we send it out through real-time recommendations that you can then decide how you best want to take advantage of real-time via your email and your smartphone. Do consult your tax advisor too before you make any investment that might impact your unique tax situation. So we're going to talk about how you can consistently swing trade the major market sectors and via stocks that give us exposure across a lot of different sectors. So we have 25 key stocks that we like to trade based on our testing that showed us the potential to make money, whether we bought calls or in some cases bought calls and puts together on other names at different times. So we're always just buying either a call or a put, but some of these securities we can trade both the bullish and the bearish side. Others we only trade the bullish side based on the history of what worked the best. You can also determine what we call reversal zones with this technical indicator I'm going to share with you, particularly the ADX, the average directional movement. And we'll talk about the directional movement indicators as well. Do cash flow, regardless of the environment, whether it's bullish or bearish, we're looking for the proper setup and then take advantage of the swing trade reversal. So let's actually jump right into it with a case study on, in this case, FedEx, FDX. In the bottom panel indicators, we've got the ADX shown in green on these indicators. And what you're looking at is how much directional movement are you getting, in this case to the downside, because the negative directional movement is shown in red and the positive directional movement is shown in blue. Negative directional movement means how much new lows you're making over a given look back period. Obviously on this example, you can see there was a straight down phase, a lot of new lows, and then when you look at the blue new highs indication, basically no new highs on that recent look back period. So those two lines are widening, and it's that widening of the two directional movement lines that says that, hey, you know what, this is a kind of a trending market. But when ADX gets too high, and I can't give away the specific number, but I can say it's certainly above 30, we start looking for a sign that, okay, when it's gotten above 30, a lot of people will say, oh, I won't even trade a trend until ADX gets above 30 or 40 or some really high number. And I'm saying by then it's too late. Our testing showed that once you get a reversal and close higher, in this case, you see ADX is still going up, but we got a reversal, close back up, and you can see that the price reversal dictated to us that things were about to change. Now, yes, by the time that they did gradually change over the next 13 trading days, we were able to make 52.9% on a 230 call that we bought for $725. So if you were allocating $1,000 a trade, you'd only get one contract for $725. That's okay. I'd rather get one contract of the right kind of option than 10 contracts of the wrong kind of cheap way out of the money option. So in this case, at that point, we're saying we've gotten our objective, which is typically about a 50% gain compared to about a 25% stop loss. And this is just a simple options purchase. When it's time to sell it, we sell it to close it out and move on to the next trade. You can see in this example on the right, the green ADX line is just never going to give us a signal after we get that first one because now the ADX is too low. It's got to keep going for a while in order to give us that signal. How about another example on the downside? This is Chevron, the Dow component CVX. And in this case, we're able to buy, when we're sitting around 129, we're able to buy a 135 strike put, usually going out at least 30 days on these options. Okay, so if we're in the middle of May, we're going to be looking out to the third Friday in June monthly expiration. So it gives us over a month to work with in time. We don't expect to need or even want to have it open that long. But if you buy an option that's worth intrinsically $6, if you buy a 135 strike put, that's a right to sell Chevron shares at 135. It's now at 129. You're saying, hey, it's already worth $6. Why am I paying 780? Because that extra $1.80, just over 20% of the total premium, is time value, and that makes sense, right? Because it still has, in this case, another 5 weeks to go before the expiration. So you pay a little over 20% in time value, and now you're just waiting for something to happen because, of course, the ADX has been above 30 on this chart for a while, and you can see it had a nice steady trend move up. Then as we got ready to see some potential reversals, it was close to the top. We weren't exact, so that first week it just pretty much chopped around there. But by buying an in-the-money put, it gives us a lot more stability and staying power to stick with the trade, give it a chance to do what it's going to do before it might hit a stop. So, from a strategy guidelines perspective, we're saying, look, we'll typically hold these 1 to 2 trading weeks. Usually we're going to go at least 4 weeks out using the monthly options. So if I'm looking at a monthly option that's only got 2 more weeks to go till expiration, I'll go out another month, and that option should have about 6 weeks to go before expiration. This gives us a lot of stability in the way we trade. We're going to average about 6 trades a month, so in the course of a year, about 70 plus trades. And generally, we're going to be shooting for anywhere between a $2 premium up to an $8 maximum premium to control 100 shares. So if we give you a recommendation at 2 and you're trading $1,000, you could trade 5 of those for $1,000 plus your commission. If you're just trading one of those, you can of course see that that's going to be something where if you're buying like a $8 option, you only get one contract. Then we just assume it's the right one to do because you're just matching up to what your maximum risk level is per trade. I'd rather see you know that your maximum risk is contained rather than take a really high risk, way out of the money option and end up never having a chance to cash it in. Stop orders are typically at minus 25%. Full profit targets are typically at plus 50. It can trickle on through there a little bit at times to the upside and the downside. But we base these stops on every single stock that we follow as individual volatility level, which is called the average true range, or ATR. There's another kind of component of the ADX and directional movement lines. Wallace Wilder, the developer of these indicators, said, look, you got to factor the true range in. How much is it gapping? Not just the high-low range of the day, but did it gap up today? That gap has to be incorporated. So you're actually getting a lot more volatility factored in with ATR. And we use a unique end-of-day entry signal to say we want to get these trades out usually to you around 3:30 p.m. Eastern Time, Wall Street time, to half an hour or so before the market closes. Could be a little bit before, a little bit after that, but that's really the sweet spot we're seeking to hit with these trades. I mean, you wonder, well, what kind of names do we trade? We mentioned a couple already that we have like to trade: Chevron in the oil sector and energy, FedEx in the transportation sector. You can see we've got retail with Target, we've got tech with Microsoft. You can see there's Visa, financials, well, WBA, drug stocks, plus 18 more different names. So a whole bunch available to you to take advantage of. So it's not like we're going to be hurting for frequency. Our bigger concern always is, it's a building of confidence phase for you in your trading, your confidence in big trends, your confidence in yourself. We really seek to help empower you to make better investment decisions. How about another example? This is Visa. Visa's been one of my favorite trading stocks of all time. It's such a consistent cash flow machine because they're taking a few percent out of every merchant's high on every transaction. Sounds like a pretty good business model, huh? Bottom line is that you can see here that the ADX was high. And this is kind of an interesting case because ADX was high back there in late January because the market had a big run up, and ADX stayed high. If you were just drawing the line across the 30 level we talked about as a bare minimum, our levels are a little higher than that. You can see it had already been above there, was staying above there. Then we got this big upside reversal. It was down to a new short-term low. Then it closes near the top of that candle there, February the 9th. And you can see that then we're buying the 110 calls. The stock's trading about 116. Again, about 6 points in the money. Again, about $1.80 a time. Just over 20% time risk, about 78% intrinsic value. And that thing just kind of keeps chugging along. It goes from 116, gets up to about 122. And so think about it, that's a 6 point move up, and we're saying we'd take a 780 and we turned it into another 390 on top of that. So we got about, that'd be a 50% gain in 9 trading days. We got about 4 points out of that 6, which is not bad. It's saying, okay, we're losing a little bit of time in that process, but we're also, still getting great leverage compared to if we bought the underlying stock. Think about it. We got only 4 out of those 6 points, give or take. In this case, the stock went up in the neighborhood of about 5%, and the options went up 50%. So we're about a 10-to-1 leverage, give or take. So this is the kind of thing you say, okay, would you rather buy the stock or buy the option? And I would say, well, it goes back to the principle of, why would you buy a stock when you can rent it or lease it? How about a losing example? We've got this is the Altria Group, part of the old Philip Morris MO as a symbol. About the 53.5 calls, the stock's trading just over 56. So we're paying like $2.50 intrinsic. We're paying about 90 cents a time. That's sort of the maximum amount of time that I would buy. And in this case, you can see that buy too much time, and it kind of, as the thing just is not moving in our favor, we're hitting a 26.5% loss 6 days later. But it never really got that much against us either. It just didn't fire. Maybe it was down a half point by the time we were getting out. We lost, in this case, you can see more like a full point because of the time erosion. So that's the kind of thing that you say, okay, that time erosion is definitely something we want to manage. So we like to buy them in the money wherever we can. How about another example with Walgreens, ticker symbol WBA? This one was just added earlier this year to the Dow Jones Industrial Average. And you can see in this case, we've got a high ADX in green. The stock's been down. It's been bashed by news that Amazon might come in and enter the pharmacy market. And you can see ADX is high, and then the price action reverses, and that is the coming right off the bottom there. You can see it just kind of keeps grinding up another day, then down a couple days after that. But then the big spike to the upside, it happened there in mid-April. You can see the Walgreens 60 straight calls, and the stock's trading around 63.5. We're again about 70% intrinsic, about 30% time. And as the stock moves up here from that 63.5 to up to about 66, you can see that we're getting on a 2.5, let's just say maybe 3-point move in the stock. We're getting a really nice 2.40 points in our favor. So that's giving you a very high delta, as we would call it in option terms, approaching 80% delta. I mean, the stock goes up a point, you make 80% of that point in your option, and of course you paid a small fraction less than 10% of the cost of the stock. So that's where your leverage kicks in. While past performance can't guarantee future results, you say, hey, if you were taking advantage of this through our options swing trader program, as you sign up, get real-time text alerts and email alerts so that you can take advantage of this. It can also be auto-traded through select auto-trading brokers that we work with to help facilitate execution for our clients, but you still keep the privacy of your account details to yourself. We just send them out to the brokers. If you're approved to auto-trade, once you become a subscriber, they check with us to make sure you're subscribed, and then you can take advantage of that. And you can call us at 800 Big Trends and ask us about which brokers do auto trade the Big Trends Alert Service programs. But what I like about this chart, you can see there's 3 different months where we're up over $1,000, almost to 4 months, because June was up 890, January, February both up 1,500-ish, May up just over 1,000. So the gains when they're hitting on all cylinders, 4 out of those 5 months, they were very, very healthy. This assumes $1,000 invested per trade, never more than that. You see April, July, and August, the 3 down months were down in the neighborhood of about $562. So if you gave up $562 compared to on the bull side, you made over 5,000, probably pushing towards 5,500. You're in the neighborhood of a 10-to-1 type of bang for your buck on the upside compared to what you lost. So the whole thought here when you're doing swing trading with options is you want to be right bigger, and when you're wrong, you want to lose smaller. So that's really the name of the game as I see it. And so you want to take advantage of that, and you can take advantage of the offer on our webpage to get you started on our swing trader program. The biggest thing is just get started, try it out. We have longer term specials as well, but bottom line is that we just want you to get started, start taking advantage of the swing trade approach, using these very high ADX reversals as something that you don't see many people talking about that. When they talk about ADX, the average directional movement, you can see the equity curve. Again, past performance doesn't guarantee future results, but it's been a very good year so far, and we're looking forward to many more great years to come. And again, if you have questions, you can always reach us toll free in the bottom left there at 1-800-BIG-TRENDS. That's 1-800-244-8736. You can call us or you can email us through client care at bigtrends.com as well. So client care at bigtrends.com. You can get our most up-to-date track records as well as more information on the Options Swing Trader program. Make sure to do so and start taking advantage of all the opportunities that Options Swing Trader provides. Thanks for being with us. I'll look forward to seeing you again real soon. Keep trading well.